As the year comes to a close, how should investors be thinking about next year? Well, hey everyone, it's John Chapman, certified financial planner with WorthPoint Wealth Management, here to give a brief overview about what we've been through and what you might look for in the year ahead. Taking a step back, the 2020 COVID pandemic restrictions caused a bottleneck in supply chain, and that led to a dramatic increase in inflation, as you can see in this chart here. Inflation hasn't reached these levels in almost 40 years. Now, as a result of this high inflation, the Federal Reserve had to step in and take action. As this chart shows, going back to the 2000 time frame, they had raised interest rates, lowered them through the dot-com burst, raised them again, and then lowered them after the 2008 Great Financial Crisis. Now, they had stayed persistently low for a number of years, to slowly being increased in the 2018 timeframe and then drop back down again because of COVID. But then, because of this inflation, interest rates were raised 6 times this year in 2022, up to about 4%. Now, the outlook going forward is that the Fed may continue to raise interest rates, but eventually be forced to turn around and drop them again. Now, the market's reaction was not favorable, and it caused a lot of volatility. Let's walk through this chart together. We can see the S&P 500 and the NASDAQ have fell 17% and 30% respectively since January this year. This orange line tracks the price performance of the 10-year Treasury bond, and that itself was also down about 12% this year, one of the largest drops in the past couple of decades. And finally, as a reference point, with all the volatility in cryptocurrency, here is a graph showing Bitcoin's price performance since January with a negative 64% return. Not a pretty picture to be looking at this year. As we shift gears and think about the year ahead, there are some positives and some negatives, and a fork in the road for the Federal Reserve and for investors. Now, one possible outcome could be that inflation stays persistently high, and maybe unemployment stays persistently low. These factors might cause the Federal Reserve to continue to feel like they have to raise interest rates to slow the pace of inflation, and that would dramatically impact the financial markets and could create more volatility. Now, of course, there's another scenario where inflation starts to cool and maybe there's only a mild recession. That allows for the Fed to slow their interest rate increases and maybe even end without too much turmoil in the markets. But of course, looking into the future is incredibly difficult and often not the best use of our time. As context, we can see from this chart over 100 years of data from the S&P 500 market. We can see that the stock market has experienced lots of 10% drops and lots of 20% drops. And while we don't know exactly if the future might look like this, we do know that disciplined investors have been rewarded in the past for staying diversified and staying invested. Let's shift gears and talk about some action items for those of you who are still 10 years or more from retirement. This is a financial calculator giving an example for an investor that has $500,000 of savings between, let's say, their 401k and brokerage accounts. Let's pretend somebody's in their 40s and 50s and has a 15-year outlook, and let's just use an example of a 7% rate of return. Let's also assume this person maxes out their 401k or finds a way to save $24,000 over the course of the year. And with these ingredients, we can see that this $500,000 portfolio could grow to $1.9 million in the future through increases in the principal and a dramatic increase in compound growth. So for those that are 10 years or more, the action steps here is you could use this market volatility as an opportunity to keep investing and use this as an opportunity to learn how financial markets work so that in future business cycles, 5, 10, 20 years from now, you have a sense of how they might shake out. Let's think about somebody that's 5 or less years from retirement. What should they be thinking about? in my opinion, they should be looking for opportunities to rebalance and reduce the risk in their portfolio as they get closer to retirement. They should be looking at ways to create a cash flow projection so they can estimate out into the future what their retirement income is going to be and how that might differ from their work income. They should also, of course, consider paying down any outstanding debt by the time that they get to retirement. Here just shows an example Excel spreadsheet graphing out an example of $50,000 coming from dividends and interest from a portfolio, $15,000 from a pension, $36,000 from Social Security. That would create a combined pre-tax income of $136,000. So again, those that are less than 5 years from retirement, creating some visual of what the forecasted income is a great use of time. And in the end, for those that are in retirement, making sure there's a good diversified mix between stocks, bonds, and cash is an appropriate thing to do. You could review how much you're pulling from your portfolio and make sure you're monitoring your cash flow and budget. In the end, it's so important to focus on your goals going into next year. And remember that financial plans have 5 components: your goals and your corresponding investment strategy, your insurance and your estate planning, and your tax planning. And working with your financial advisor and your financial team can put you on the best track for next year.